We've talked to brokers who lost weeks of profits in just single session during the January gold spike. And with what's happening this week in gold and oil, the same thing is playing out again right now. And that kind of uncertainty is exactly what breaks brokers and traders who are not prepared. This is the new normal, and it's exposing every crack in the broker infrastructure, risk management, and execution quality. Today, we'll walk through the 5 most important tools and practices that will keep you safe when markets go crazy. It's happening right now. So the question is, are you ready for it? Hello and welcome, everyone. I'm Egorov, Global Head of Sales at TFB. Thank you for joining today's session, Oil Rush, Top 5 Tools to Survive in Extreme Volatility. And we are coming to you at the moment when this topic could not be more relevant. Gold is sitting near its lowest point of the year, around 4.4K, after a gold crash in January, gold rush in January. Oil went down from $113 to $92 in just a single day yesterday, after Trump paused strikes on Iran for 5 days to negotiate, and the Strait of Hormuz is still closed. So nobody knows what happens next, and that uncertainty is exactly the problem. This is not a theory, it's happening right now, and today we'll walk through the 5 most important tools and practices that will keep you safe when markets go crazy, whether it's gold, oil, or whatever instrument catches fire the next. A quick intro about myself. I've spent over a decade in fintech, working closely with more than 100 brokers and hedge funds around the world, helping them to build better infrastructure, cut latency, and automate operations. Outside of work, I'm into sports, mostly road cycling, so performance is something I care about, not only in job, but in my life as well. And today we'll talk about a very specific kind of performance. It's how to keep your brokerage running smoothly when the market is doing the best to break it. A few words about tools for brokers. We've been in this industry for over 15 years, serving over 200 clients from more than 40 countries, and over 100 brokers and hedge funds are running our trade processor Liquidity bridge right now. And what makes us different? We are not just a bridge provider. We've built a full ecosystem of more than 25 products that work together, from execution and risk management to reporting, corporate actions, automations, PAM, and more. Everything is designed to work seamlessly under one roof, so there's no integration headache, no compatibility issues. And besides that, we offer 24/7 technical support, which, as you will see today, matters a lot when markets get extreme. Here is what we will cover today. So first, we'll look at what actually happens to brokers when gold, oil, or silver goes extreme. Then I'll walk you through the top 5 tools and techniques that help in these conditions. And we'll talk about building resilience, look at real case studies, and also I'll share practical crisis checklist so you can use it right away. And then we'll wrap up with Q&A session. So whenever you have questions, feel free to post them in Q&A box. And we'll be glad to answer them in the end of this webinar. So let me paint first the picture of what's going on right now. And I mean literally right now, not weeks ago. So gold had a wild start to 2026. It broke through 5K in late January, shot up to nearly 5.6K, and then crashed 12% in just 2 days after Fed chair nomination took the market. Then it rallied again about 5.7K in early March when the US and Israel launched strikes on Iran. And just yesterday, the day before this webinar, gold dropped below 4.3K, and that's the lowest level of the entire year. And 1,400 swing from the March peak to today in just 1 month. Oil is just as dramatic. Brent was around $70 before the conflict started and nearly hit $120 a barrel 2 weeks ago. And yesterday it went down to $92 in just a single session after Trump plus strikes on Iran for 5 days to negotiate. And the Strait of Hormuz is still closed, so nearly 20% of global oil supply flows through it. And nobody knows if talks will actually succeed or not. And that kind of uncertainty is exactly what breaks brokers and traders who are not prepared. So the gold volatility index hit 37 back in February, and that was already triple the calm levels from the few years ago. And since then, it's only getting more and more intense. So oil volatility is well above 30, and silver has been spiking too. So this is not some one-off events. This is the new normal, and it's exposing every crack in the broker infrastructure, risk management, and execution quality. So the question is, are you ready for it? And let me break down what really happens when volatility spikes and why so many brokers struggle. So first, your B-book gets risky fast. When gold gaps 50, 100, or even 200 pips, your B-book exposure can flip from profit to disaster in just seconds. Slippage, delays, price gaps, all this creates negative balances, and that means chargebacks, disputes, indirect losses. And we've talked to brokers who lost weeks of profits in just single session during the January gold spike. And with what's happening this week in gold and oil, the same thing is playing out again right now. The second, your A-book takes a hit too, and your liquidity providers blow out their spreads. Market depth dries up, margin go up, and you start getting more rejects. And your hedge quality drops as well. And you think that you are covered, but you're actually filling clients at one price and getting hedged at a much worse one. And the third thing, it's your infrastructure gets overloaded. Breaches start queuing, requotes pile up, and dealers cannot keep up. And it's literally just impossible for some brokers to manage it for 24/7. And we've seen processing time go from 5 milliseconds to 500 milliseconds during a spike. And that's basically 100 times slower. So it's not just a delay, it's a system failure. And fourth, toxic flow gets much worse, and scalpers, latency arbitrage traders, and fast strategists, they love volatile markets. And they exploit every millisecond of your delay and every gap between your price and the LP price. If your system is already slow with normal conditions, extreme volatility turns you into an easy target, and that's the worst part. These four problems, they hit you all at once. So let's speak about the tools and how to confront those problems, those issues that you might face. So the tool number one, it's probably the most important, and one of the most important, definitely, and we've heard about it from many of our clients who use it. Is dynamic margin leverage control, because most brokers, they still use fixed margin settings. You set leverage to 1 to 200 or 1 to 500 on gold and leave it there. But when gold moves to 1,400 in 3 weeks, like it just did, that leverage becomes a time bomb. So what you need basically is a system that changes margin rules automatically based on what's happening in the markets. And you can plan this in advance if you know that some news are coming. So when volatility crosses a certain level and when the average daily range on gold doubles, your system should raise margin, cut leverage, and cap position sizes. Not after a meeting, not tomorrow, right now, and ideally it should happen automatically. The key here is the balance. You don't want to shut down trading completely because it would kill volumes and push your clients to competitors. But you need to tighten the limits before the damage happens. And think of it like speed limits that's adjust based on weather conditions. So when the road is clear, you can drive fast. When it's storming, slow everyone down. Simple rules that work: raise margin when daily range is 2 times the 20-day leverage, 20-day average, and cut max leverage by half during major news events. So set per client volume caps on instruments with extreme spreads. And here we come to the tool number 2, and that's liquidity aggregation with dynamic execution profiles. We've covered segregation in some of our earlier webinars, and during extreme volatility, it becomes absolutely critical. Here, what happens when gold or oil spikes? Some liquidity providers widen spreads to 10, 20, or even 50 pips. Others stop quoting entirely. Some increase their last look window so much that they reject 30 to 40% 30 to 40% of your orders. And if you are running a single liquidity provider or even 2 LPs without smart routing, you're basically flying blind. And when oil swinging $20 a barrel intraday, like it happened this week, this is not hypothetical. So what you need is a real LP scoring. So your system should measure each LP spreads, fill ratio, response time, and reject trades and prioritize the ones performing the best. So not based on yesterday numbers, but right now in real time. And when you need failover logic, if your primary LPs stops quoting for 5 seconds or 30 seconds, you define what would be the piece value. It happens during spikes. So your system should instantly switch to the next best liquidity provider. And no dealer clicking buttons, no support tickets, automatic failover in trade producer. That's what's resolved this specific problem for our clients. And aggregation engine scores liquidity providers in real time, and it can switch routing in milliseconds. Now here is a feature that's unique to trade producer and really powerful for volatile markets. It's execution profiles that you can schedule in advance, so you can pre-configure completely different chains, different routing, different markups, different liquidity providers, and different aggregation modes, and save them as separate profiles. For example, you might have normal market profile and a crisis mode profile, let's say. And you can switch between them manually with just one click or set them to switch on schedule. And if you know major news events is coming, so like NFP release or Fed decision, you can schedule your crisis profile to activate automatically during that window. So this is something none of our competitors offer in the same way. And it's incredibly useful when you need to change your entire execution logic fast without reconfiguring everything from scratch. The tool number 3, it's one of the most powerful features we have in Trade Producer. And this is the one that we just recently improved. And this built specifically for the problem that we are talking about today. So how do you run bbook without getting destroyed when volatility goes extreme? Here is the situation. You're running bbook on gold. In normal conditions, your exposure is manageable. But when gold drops 1,400 in just 3 weeks, like it literally just did, your bbook exposure can reach dangerous levels in minutes. And traditionally, brokers handle this manually. So someone on the dealing desk watching the exposure calls the risk team and they decide what to do. So by the time that happens, you've might already lost the money. bbook risk offset, it solves this by letting you set automatic exposure limits per instrument. So let's say you decide that your maximum bbook exposure on gold should be 500K units. And you can figure this in trade processor or in other system. And from that moment, anytime your bbook exposure crosses that threshold, the system automatically hedges the excess volume to your A-book liquidity providers through aggregation modes or without. This is up to you. And there is no manual intervention, no delays. And you get 3 modes depending on how you want it to work. So exposure limiter would just keep your bbook exposure in a specific range with both minimum and maximum value. And if exposure gets too high, it hedges to A book. If it drops too low, there is volume on A book and it would bring it back. Accumulate in hedge lets exposure build up on B book. And when it hits your threshold, the whole accumulated amount gets hedged at once. And the third one, the exposure cap, it's simply hedges anything that goes over your limit. So keeping a hard ceiling on your bbook risk. So this is the game changer for volatile markets, and you can keep profitability of bbook during normal conditions, but you have an automatic safety net that kicks in the moment things get extreme. And the best part, it's all configurable per instrument. So you can have different limits for gold, oil, silver, and everything else. Tool number 4, real-time monitoring with toxic flow detection and automated alerts. This is where many brokers still rely on human judgment, and that's a problem, especially in volatile markets. Because during the January gold rally, prices moved 700 in just 3 days. During the recent Iran conflict, oil went from $70 to nearly 120 in 2 weeks. And just this week, gold crashed from 4.6K to 4.3 in a single day. So at that speed, by the time your risk manager opens a dashboard, reviews the data, calls the dealing desk, and decides to change something, the loss has already happened. First, you need a monitoring system that never sleeps. So you can set threshold alerts for total exposure per instrument. And if your net gold exposure exceeds certain amounts, the system alerts immediately. And if your liquidity provider rejects rates spike above 15%, you also can get a notification. And if average slippage crosses 3 pips, the system flags it. But here is where we go further than anyone else in the markets. It's with our brokerage business intelligence, or shortly BBI. This is the client analytics engine that is built into the trade processor and automatically analyze clients' trading behavior and segments them into various pools based on patterns that you define. So, for example, you create a pool that catches traders where more than 80% of their profits closed within 5 seconds or 10 seconds. So traders whose profits, let's say, who are consistently profitable with golds, with high volumes, or those traders whose profit exceeds their deposits by a specific percentage. So all these are classic toxic flow signals: scalpers, latency arbitrage, news traders. And once our BBI system identifies these traders, they're automatically placed into a pool. So you can use that pool directly into your trade process routing rules. So for example, you can automatically reroute all toxic flow accounts from B book to A automatically. And you can set this up in a manual mode, where your dealing desk confirm each entry, or in automatic mode where it happens without any intervention. And you can set up alerts through Telegram, email, or SMS, whenever an account enters or exits this pool. So this combination, real-time exposure monitoring, automatic trader behavior analysis, and automated routing changes, this is what gives you the edge during the extreme volatility. And your risk team sets the rules. The system just enforces them at machine speed. And tool number 5, I would say even approach number 5 here, it's infrastructure resilience. So during extreme volatility, your technology becomes the most important factor. And here is a real example. So during the initial oil spike in late February, a broker we spoke to, not our clients, had a complete bridge failure for 47 minutes during peak volatility. And their system couldn't handle the volume. So orders queued, clients couldn't close their positions, and by the time it came back online, the damage was done. And with what's happening in the oil market this week, this kind of failure risk is higher than ever. So this is completely preventable. And first, it's a collocation. So if your servers are too far from your liquidity providers, even millisecond or extra latency, it gets worse during volatility. So from let's say 1 millisecond, 2 milliseconds, it might go to 10, 50, and even more. And if you move your servers to tier 1 facilities like LD4, NY4, where you cross-connected to your liquidity providers, you can resolve this problem. The second thing is failover. So you need a live backup instance of your trading engine that can take over within seconds if the primary system goes down. And in Trade Processor, we deploy the backup configurations for all the clients who need it. And these also can switch automatically whenever the system, like if it's down in some reasons, the connection to hosting provider is lost or the server just overloaded. So there is possibility to switch. And the third thing, it's the raw performance. Our system can handle up to 2,000 orders per second on MT5 with an average execution time of about 1 millisecond and lower. It can process 1.5 million quotes per minute. So these are not just marketing numbers, they are from our actual load tests on production hardware. So that's the kind of throughputs that you need when gold gaps and everyone hits the sell button at the same time. And the fourth, it's health monitoring. So your system should continuously check its own vitals like CPU load, memory, message queue depth, LP connectivity. So even if the price hit on one instrument is stopped, you need to stay aware of it. So if anything crosses danger threshold or something is disconnected, you should get an alert and the failover should trigger automatically. So the brokers who survived recent volatility without a scratch all had one thing in common. They invested in infrastructure resilience before they needed it, not after. And let me share some real case studies. This large retail broker with over 50,000 active accounts was hit hard during the January gold spike. They were running MT5 with the third-party bridge and single liquidity provider and fixed margin rules. So slippage exceeded 8 pips on gold trades, and their reject rates spiked to 35% at some point. And they had 3 separate margin call incidents where clients went into negative equity. So what we did is we deployed the trade processor with multi-book aggregation across several liquidity providers and set up dynamic margin rules that tighten when gold's volatility crosses certain threshold. So it can be predefined by schedule and you can switch automatically. And also we configured the execution backup for automatic liquidity failover. So within 28 days, using the same LP, slippage dropped 74% and reject rates fell from 35 to 6%. And when the oil spike hit in late February, they had 0 margin call incidents and with the same LP, same hosting, just in other technology. Case study number 2, this one really shows the power of bbook risk offset. And there is a mid-sized commodities broker in MENA region that was running 100% bbook on gold and oil. And during January gold spike and the February oil disruptions, their bbook exposure on gold ballooned over 2 million, completely unhedged. And they lost over 300K in a single session. So the problem wasn't the markets. It was that they had no automated way to limit their bbook risk. And we deployed trade processor with bbook risk offset for them, configured in exposure limiter mode on 3 instruments, in gold, silver, and oil. We set the maximum bbook exposure to 50 lots per instrument. This limit can be defined according to your risk appetite. And we connected 3 A-book liquidity providers in an aggregation pool that's so that whenever bbook exposure crosses the threshold, the trade processor automatically hedged the excess volume to those liquidity providers through continuous execution. So this is basically a functionality that allows you to not swipe up the whole market depth at once, but to split the part whenever you need to hedge big volume. It can split it in parts, so just to get better price. And the results speak for themselves. During March oil volatility, bbook exposure on gold and oil never exceeded the limit, not even once. And the system triggered automatically hedging 14 times in a single week, all without any dealer involvement. So based on what the unhedged exposure would have been, they estimate they avoided roughly almost 300K in potential losses. And all of these was set up in just 30 days with the same LP. And this kind of safety net that simply doesn't exist when you run your bbook manually. So you can keep the upside of bbook in normal markets, but when things get extreme, system and technology can protect you automatically. And the case number 3, the broker that was dealing with the toxic flow. And during the gold volatility, their high-frequency clients became much more active. So toxic flow tripled. They were leaking 95K per week from latency arbitrage exploits. And they could see that it happening, but had no automated way to respond. So we deployed trade processor with BBI, our broker business intelligence module, and configured BBI pools to automatically detect traders with the short-lived positions, so under 60 seconds, and with a high win rate on gold and silver. So once our system detects these accounts, they were automatically rerouted from B-book to A through routing rules without any manual confirmation needed. And we also enabled B-book risk offset on gold and silver to cap their B-book exposure automatically. So as a result, toxic flow P&L impact dropped by 68%, and B-book gold exposure was capped with zero manual intervention. And the time from detection to action went from hours, when dealers had to notice the pattern and to make a call, to under 60 seconds with BBI running automatically. And this all in just 42 days, again, without any changes in liquidity providers. So now, as promised, the one-page crisis checklist, we'll share it after webinar, but I'd encourage you to screenshot this one or wait for the recording. So this is up to you. 3 phases: before, during, and after. Before the spike, this is where most of the work should happen. Should review your margin settings, set dynamic triggers, test liquidity providers failover using the backup in your bridge. And this actually simulates an LP going offline and verify routing switches correctly. Because it's the worst thing, but when you find out that your backup doesn't work when it's most needed. So that's why it's better to check it beforehand. Make sure that your backup bridge instance is live. Pre-configure the crisis execution profile so you can switch your entire execution logic with just one click, and set B-book risk offsets thresholds on volatile instruments, and launch BBI pools or other risk management system to detect toxic flow patterns before they cost you money. So even if you haven't done these things yet, today's market is telling you that it's time. During the spike, monitor exposure in real time. So watch liquidity providers reject trades. And if conditions get bad enough, switch to your crisis execution profile. Reduce slippage and cap volumes as needed. And after the spike, review everything: slippage, fills, rejects, LP performance. Check your risk management system for new toxic accounts that appear during the market, and document what happens. Update your playbook, and critically stress test at 3 times your peak volume, because the next time it might be even bigger and no one knows how big it will be. And let me summarize the volatility playbook in 3 simple rules. So rule number 1, it's when volatility rises significantly, raise margin by 25 to 50%, reduce max leverage, and switch to your crisis execution profile. So don't panic and disable the instrument completely, because it might kill the revenue and send your clients to competitor. And tighten control when it's needed, but don't shut it down. Rule 2, it's when your liquidity provider's quality drop and you see that reject rates above 15% or spreads blow out to 3 times from normal. Automatically reroute your execution flow to backup liquidity providers using your execution backup. So don't sit just hoping that your primary liquidity provider recovers. And rule number 3, it's when toxic flow surges, you can use the risk management system such as BDI to detect and reroute your accounts from B-book to A, then enable B-book risk offsets so your B-book exposure is capped automatically. Don't ignore and absorb the losses. And protect yourself without killing your business. So better automate and don't panic. And before we go to Q&A session, let me recap the 5 tools. So the first one was dynamic margin and leverage control. So your first line of defense against negative balances. That's automatically increase margin requirements when market volatility spikes. And it also reduces the risk of large client losses and protect them from negative balances. Number 2, it's smart liquidity aggregation with failover routing and profiles. When your LPs go bad, and they will during spikes, maintain execution quality automatically. And the execution profiles, you can switch your entire execution setup to crisis mode in seconds. So manually or by schedule. And the number 3, it's bbook risk offset. This is unique to trade processor. Sets limits on your bbook exposure per instrument, and the system will automatically hedge everything over that limits to your A-book LPs. So no manual intervention, and 3 flexible modes to fit your risk appetite. And number 4, real-time risk monitoring that can be combined with your business intelligence or toxic flow detection. So your risk team sets the rules, which trading patterns are dangerous, which accounts need to be rerouted, and the system will automatically identify them and reroute them without any manual confirmation. And number 5 here, it's infrastructure resilience, collocation, failover, performance. So trade processor can handle 2,000 orders per second on MT5 with just about 1 millisecond execution time. And that's the throughputs that you need when everyone hits sell at the same moment. These 5 tools together create a complete defense system, and they are all part of our ecosystem, built to work together, not bolted on from different vendors. So thank you for your attention. Now let's hear from you. Please drop your questions in the chats if you haven't raised them yet, and I'll answer as many as we have time for. And whether it's about bbook risk offset or toxic flow detection or anything else that we discussed today, feel free to ask. Okay, I see we have some questions. So the first one, it's when we raise margin during volatility periods and clients start complaining right away, how to handle this without losing their trust. So here, I would recommend you to inform the clients in advance. So it wouldn't be a surprise that you increase this margin requirements. And there are many big brokers in the markets who have it as rules that they publish on their website that, let's say, 50 minutes before news time and 5 minutes after, you have so-called HMR, high margin requirements, when you decrease the leverage and increase the margin required to keep those trades open. So this is normal for our markets, and this is not something that's just you would implement. So it's just essential risk management, I would say. The second question is how to actually test the bridge and infrastructure and make sure it's can survive high volatility. That's a very good question, because we saw many clients who had backup in place but never tested if it really works. So here would recommend to just plan this in advance, ideally when the markets are not volatile. So better that's when there is the minimum trading. So you can just inform your clients in advance that you are planning to perform some maintenance works. So it would take you just up to 5 minutes to test the whole switch. Usually it can be done even faster. It depends on the bridge that you are using. And it takes not much time, but you will sleep well and know that even if something goes wrong, you have a system in place that will work as a failover in case of some incident. And the third question that we have, it's, let's say, if risk controls are already set, what else should we check before the next market spike? I would recommend to, again, to most of the things we discussed during the webinar. So I would recommend to monitor the liquidity provider's performance. So besides the risk controls, it's also very important that if you hedge with your LPs, to check reject rates, to check the spreads from liquidity providers, because we see many brokers who rely completely on their liquidity providers, and they believe that if it's 100% hedged, there is no risk. But there were these situations in the past when markets had some huge moves within just minutes or hours, and it might not be enough to have just one liquidity provider and rely on that one completely. So better to monitor performance of your liquidity providers and to switch between them accordingly when it's needed. So that's the main advice that I would give in these regards. If you have any other questions, you can contact me directly. So here is the QR code that you can scan and text me on LinkedIn, or it's quite easy to find me on LinkedIn, or just go to our website and contact my colleagues. We'll be glad to assist you. And thank you again for joining. We'll send you the recording, slides, and the crisis checklist that we showed today. And if you'd like a personalized review of your current setup, where we can assess your infrastructure, execution, and risk management, and give you some recommendations on specific improvements for volatile markets, just reach out. We can also set up a demo of our trade producer system in your environments, or you can see it in our play demo environment, so you can see them in action. And see you the next one. Stay safe, stay resilient, and have a great day.